Our next guest, we've been talking about actually all week, and this happens once in a while with Paulsen, doesn't it? And Jim, at the risk of being too arcane or making it too hard to understand, I was having quite a bit of trouble trying to figure out what you were saying in your latest note. It was bullish, I think, in terms of finding a bottom, but it had to do with the behavior of yields based on inflationary expectations and tips. And you said there's some fundamental differences, and you went back historically and looked at if it was the way it happened in 08, a year later, you're 9% lower. But if it happens the way you're saying it happened now, you're actually 12% higher over the next year. And so I guess I saw that and thought, I want to hear the story about how we could be 12% higher in the next year.
Well, I don't know if that'll be the case, but I did look back. I think the bond market's playing a big role here, Joe. I think it has all the way through. We've worried even last year, what does the bond market know that the stock market doesn't? And now, of course, it's broken down below 1% yields, and people worry, are we headed for negative yields in the United States? That might be as big a fear on Wall Street as the coronavirus in some regard. And indeed, it doesn't escape my attention that bond yields have, in the last now 2 going on 3 days, have had their first major bottom since this whole thing started. If we can bottom the 10-year yield, we might bottom the stock market. So it's important to look at that. What I looked at was how different the message coming from the bond market is today versus what it was in 2008. In 2008, between roughly the last half of 2008, between June and the end of the year, the 10-year Treasury bond yield fell about a little less than 1%, but the embedded inflation expectations and tips, what the bond market is suggesting there is their inflation expectation, fell about 2.5% over that same time period, from 2.5% all the way to 0. So even though yields were falling in 2008, the real yield was surging higher, hurting an economy that was already in peril.
Okay, so real yields actually
today,
went up.
Nominal
yield. Okay, so nominal yields went down, but real yields went up, so that put a damper on economic activity.
That's right. Today's very different in the sense that we've had this colossal collapse in bond yields here, but they've gone down much more than have inflation expectations. Indeed, we have a negative real yield today, so the real yields actually collapsed here this year and over the last year, and the result of that is it's a benefit to an economy that's under stress. So I think it's a very different message, and if you look back historically over the last 20 years or so, when nominal yields fall faster than inflation expectations, you tend to have a better response in the future from the stock market than you do if nominal yields fall and the real yield goes up. So I do think it's a little encouraging. Yields scare you when they're falling so fast, but it's actually maybe a better message for economic growth and a better message for the stock market than people perceive.
Well, you got a lot of time on your hands to have noticed that, but when you wrote it, I know. I told you the other day. I told Becky about it. So I get it, though, because it went in 2008. If the yields fall and then inflationary expectations fall even further, then you're getting a negative yield, right? Or you're getting
Joe, I'll give you one more message out of the bond market. You know, people are worried that bond spreads or credit spreads are blowing out, and if you look at the investment-grade credit spread, it's risen dramatically. But this credit spread blowout is occurring while the actual mortgage rate is falling. And it's all about how much the Treasury yield's going down, not how much the mortgage rate's going up. Normally, when spreads blow out, it's because the mortgage rate rises or the corporate bond yield rises. So here we have corporate yields falling, and supposedly that's going to pressure balance sheets. I think it's a different looking credit spread blowout than it was, let's say, in 2008. And so there's very different messages coming out today.
What does that mean? Does that mean you actually would put money into stocks right now?
Becky, I don't know where the bottom is here. I think we're close to it, though. I really do. This thing just oozes panic to me. The movement, the ferociousness and speed by which stocks have fallen, and now bond yields, looks more like the end of a colossal panic than the beginning. So I would start oil too. Yeah, you're right, Joe. I would start to nip away at it on these kind of down days that we have.
Right. That's my point. I mean, if If you don't want, what do you need to really show you that the markets understand the panic? If you don't think what we've seen has been representative of somewhat panic, then I don't know what you want at this point. And that's usually when, it's easy to be even more frightened. But that's usually it's always hardest right at that time to keep your wits.
It is.
Right? And we've seen it so many times historically that, one of these days you're going to figure it out.
One thing I'd say, Joe, that I think I'm looking forward to is one of the things that's happened here is we've become completely untethered from economic data, economic and earnings data. No one cares about it.
Well,
because we all know it's stale and we're waiting.
Right.
But you don't know where they're going to be.
When you become totally,
you're assuming the worst. You don't know how far they're actually going to go.
That's what I was going to ask Jim.
That's right.
The math that you've done on this.
You assume the worst.
I'm sorry.
Economic damage, right? Assume 2 months out, everything shut down. What happens?
Yeah, I guess, Andrew, what I'm saying is, if you have no fundamental, thing to look at to keep you grounded, what happens is you end up pricing securities on the basis of your worst nightmare.
Right.
And so investors, completely untethered from any fundamental information, are just pricing on their fears. What's going to happen now? Maybe yet this week, tomorrow's claims, we get confidence numbers this week, and we're going to start actually getting reconnected to fundamental information about what's happening on the ground.
Jim, I have to say, the stuff we heard from the airlines, from the cruise industries, the actual real-time information they've given us has been the worst nightmare type of stuff.
I agree, Becky, but here's what I think could happen. We could get, no doubt the economy's going to slow. We're going to get bad economic data coming out. But the real question isn't, is it going to be bad? The question is it going to be worse than feared? Because if it turns out that the economy isn't collapsing as bad as we feared, that's good news.